Most people pay thousands of dollars in insurance premiums every year while barely understanding their coverage. They only discover the catastrophic gaps in their policies when disaster finally strikes. To fix this, you have to understand the core math of risk pooling. Insurance is a system where a large group of people each pay a small, predictable amount to cover the massive, unexpected losses of a few. The insurance company makes its profit in two ways. First, by collecting more in those small premiums than it pays out in claims. Second, by investing the float, the pool of your premium dollars they hold before any claims are ever paid. Treating insurance like a prepaid maintenance plan for routine expenses ignores its primary function, transferring catastrophic financial risk to someone else. This chart maps out exactly how to categorize that risk. On the bottom axis is the likelihood of an event occurring. On the vertical axis is the financial severity. Down in the high likelihood but low severity corner are minor events, routine doctor visits, or a fender bender. Compare that to the top left quadrant. These are low likelihood but highly severe events like totaling a car, a major house fire, or a 90-day disability. These are the events that cause bankruptcy. The goal of optimizing your insurance is to stop spending premium dollars on the minor events quadrant and shift that money toward shielding yourself from the major events quadrant. Overpaying to eliminate out-of-pocket costs for minor inconveniences mathematically guarantees you will leak wealth over your lifetime while remaining exposed to total financial ruin. To control that wealth leak, you must look at the three specific terms that dictate the true cost of any policy: the premium, the deductible, and the out-of-pocket maximum. The premium is the fixed, regular payment you make every month or year. You pay this to keep the coverage active, whether you file a claim or not. The deductible is your upfront financial skin in the game. It is the mandatory amount you must pay out of your own pocket before the insurer contributes a single dollar to a loss. The out-of-pocket maximum is your safety net. It represents the absolute ceiling you will pay in a given year. Once you reach that limit, the insurer covers 100% of the remaining costs. These terms operate on an inverse relationship. If you demand a low deductible, you are forcing the insurer to take on high-frequency risk. They compensate for that risk by charging you a much higher monthly premium. If you accept a higher deductible, you take on that high-frequency risk yourself. In exchange, the insurer lowers your premium, putting that monthly cash flow back into your control. Trading higher deductibles for lower premiums is the foundational step to legally reducing your lifetime insurance costs. Health insurance is the category where consumers most frequently misallocate their capital by trying to prepay for minor medical visits. Take an HMO plan. The input here is a lower monthly premium. In exchange, you submit to strictly coordinated primary care, where a single doctor must approve any specialist referrals. The trade-off with an HMO is a loss of flexibility. If you consult an out-of-network specialist to treat a specific issue, your coverage drops to zero. You pay the entire bill yourself. For a healthy consumer, the optimal structural choice is a high-deductible health plan, or HDHP. The HDHP trade-off is clear. You accept significant out-of-pocket cash risk before the coverage ever kicks in. But by taking on that early risk, you secure the lowest possible monthly premium. An HDHP grants you legal eligibility for a health savings account, or HSA. This account offers three specific tax benefits. Your contributions are tax-deductible, the balance grows tax-free, and your withdrawals remain tax-free when used for medical costs. For healthy individuals, selecting an HDSP is a strategic wealth-building maneuver. You keep the premiums low, invest the difference in the HSA, and let the balance compound over decades. That same misallocation happens with property and auto insurance, where people routinely choose to be critically underinsured to save a few dollars. Many people buy state minimum auto liability coverage because it achieves the lowest legal carrying cost, but this creates a massive personal liability threat. On the left is the state minimum liability limit. On the right is the actual cost of a severe accident. Choosing the minimum means you absorb that massive gap. If you exhaust your limit, victims can pursue your personal assets through lawsuits and wage garnishment. The 100, 300, 100 coverage standard, $100,000 per person, $300,000 per accident, and $100,000 for property damage, is the baseline for protecting your assets. Homeowners insurance has a similar flaw, insuring a property based on its current market value. If your home is destroyed, the market value is irrelevant. You need the replacement cost rider to ensure the insurer provides enough capital to physically rebuild the structure at current labor and material prices. If you don't own a home, renter's insurance is a rare value. For roughly $15 to $30 a month, it provides property protection and shields you from liability if someone is injured in your home. Optimizing these policies requires recognizing that slightly cheaper premiums are usually achieved by shifting catastrophic risk directly back onto your own shoulders. While people stress over their cars and homes, they often ignore disability insurance, the most statistically important coverage available for long-term wealth. A 35-year-old faces a 25% probability of experiencing a disability lasting 90 days or longer before they reach age 65. Any occupation long-term disability policies are cheap, but your claim can be denied as long as you are physically capable of performing any minimum wage job. Own occupation policies cost more, but they guarantee income replacement if an injury or illness prevents you from performing the specific profession you were trained for. Your lifelong earning potential is your largest financial asset. Relying on weak occupation definitions leaves that asset exposed to a critical failure in protection. The optimization strategy across every category is to raise your deductibles to the maximum amount you can self-fund in a high-yield savings account, then use the savings to buy higher liability limits. This scorecard maps out the adjustments for your specific profile. If you are budget-conscious and underinsured, you should prioritize renter's insurance and move away from state minimum auto limits to protect against lawsuits. If you are an optimizer with no dependents, your required moves are pairing an HDSP with an HSA, securing own occupation disability insurance, and skipping life insurance until someone actually relies on your income. For an overinsured family, the adjustments include bundling home and auto, verifying replacement cost coverage, and using pure term life insurance. Families in this category should stop losing cash to ultra-low deductibles. Instead, use the DIME method to properly scale a term life policy so your dependents are protected for the long term. Effective insurance planning shifts premium dollars away from minor inconveniences to mathematically protect your assets from total ruin.